You're listening to The Money Hour with your host, Tina Mitchell. Sponsored by Absolute Mortgage, a division of Pinnacle Capital Mortgage Corporation. Now, in the studio, local mortgage and finance expert, Tina Mitchell.
Well, welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here at 1150 AM KKNW, the Saturday, October 8th show. I'm committed to providing you knowledge needed to be successful in every area regarding your finances. Knowledge is power, and that's what the show's about. That's what you'll receive from listening to the show. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but you can always call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. Right now in studio, always a pleasure to have Mathew take time to come in and visit and share his wealth of information with my listeners. Mathew Gardner, Chief Economist with Windermere Real Estate.
Hi, Tina. How are you?
I'm doing just fine, Mathew. I know you've been doing a lot of traveling with all of your speaking engagements and everything that you're doing with your position over at Windermere. And again, I just really appreciate you taking time to share what's happening in our economy with my listeners.
Always happy to be here.
So a little bit about Mathew. As Chief Economist with Windermere Real Estate, Mathew Gardner is responsible for analyzing and interpreting economic data and its impact on the real estate market on both a local and national level. Mathew is former principal of Gardner Economics and has over 25 years of professional expertise both in the U.S. and the U.K. Mathew chairs the Board of Trustees at the Runstad Center for Real Estate Research at the University of Washington, sits on the Urban Land Institute Technical Assistant Panel, and is an advisory board member for the Runstad Center for Real Estate Studies at the University of Washington, where he also lectures in real estate forecasting. So, Mathew, some are still talking about the new housing bubble. What's your take on it?
The bubble question. This is, if there's a question I'm asked 15 times a day, it's that.
Yes.
Are we in another bubble? And the very simple answer to that is absolutely not.
Okay.
And there's lots of different reasons why. There's some straightforward indexes which I look at, which is, let's say, price. And so have prices been rising? Yes. But if you look at compared to the previous peak, in a lot of markets, we're essentially where we were 6 years ago.
Yes.
And at the same point in time, you've also got mortgage rates, which are about 2.5% lower than they were. And we've seen some income growth and what have you. So combining those things, that says it's okay. There's also some other things that I look at, which is mortgage availability. Everyone assumes that there's just this endless pot of money out there that if you want a mortgage, you can go and you can get it. That's actually not the case. Mortgage availability numbers are actually up. They're still well below where we saw them pre-recession.
Yes.
That tells me that banks are being somewhat cautious, which is good in terms of their lending. And we talk about lending policies as well. They've obviously changed dramatically. We've moved from the fact of essentially having a heartbeat, you can get a mortgage,
yes,
2004, 2005, to almost the other end of the spectrum. We're now at a point whereby you've got to have remarkably good credit and certainly be able to pay that bill at the end of every month. So when you combine all those factors together and look at the fact we're seeing considerable more demand now than we've seen for quite some time. Even if we see, if we look at household formation numbers, for example, if we see the ownership rate even drop down further from where it is right now, let's say to 60%, which will be an all-time low. Over the next 3 years, we still can have to have a demand for about another 5.5 million owner households. So there's there's a large amount of demand there, limited supply.
Yes.
Prices are certainly going up, but on a national basis, I'd say, yeah, bubble, absolutely not. Now, there are a couple of markets which are concerning.
And what markets are those?
I knew you were going to ask me that. I'm a bit worried about Denver. I'm worried about Dallas. I'm worried about the Bay Area.
Really?
And just the fact you look at San Francisco, got a median home price there right now, about $1.3 million.
Yeah, that's crazy.
And now they make more money than we do in Seattle, but not that much more.
Yes, yes.
So you talk about it in that respect. Some markets I'm watching closer than others. Seattle is just fine. But on a national basis, no bubble in sight.
So you talked about the inventory and the lack of it. What do you see happening with the inventory? Do you see that this is going to be improving? And what type of impact would that have if it was a little more accessible to find a property out there?
Well, again, one of the biggest problems that buyers have got out there. I mean, getting out, see, a lot of buyers getting remarkably tired, chasing a very limited amount of homes. All of a sudden, you've got multiple offers and escalation clauses and writing wonderful letters to the owners saying, please sell to me.
Yes.
That can get boring very quickly.
Yep.
Next year, do I expect to see a modest increase in inventory? I think we will see that. Will it be enough? No, it's still going to remain, I believe, heavily a seller's market.
Okay.
But we'll see some more. Now, normally what you tend to see when markets are very, very tight, builders building a lot more houses. That's the one missing piece of the equation. We haven't seen that. You have a lot of builders, larger builders, are just holding off saying, well, why flood the market? We can see prices go up. That kind of makes sense.
Yes.
Smaller builders are also having a problem because they want to build speculatively. And they're having a hard time borrowing money from the banks to do that. So if you're going along to a plat and saying, I want that house, they'll say, great, come back in 120 days, it'll be ready. Well, we're not going to wait that long.
Exactly.
So therefore, we're going to go back to the resale market. So we're going to see some increases in inventory, yes, through the course of next year. We've already started to see a slow move in Seattle towards a more balanced market, but it's still not there yet.
You know, I was just going to ask you that next question. It's funny that you just brought that up, because why are we seeing that there's not quite as many multiple offers, or it's not as crazy, but the inventory isn't? I mean, we're not getting more homes. So what do you think? Is it the election that's... People are just kind of backing off a little bit? I know we never talk politics here with you, Mathew, but I don't talk politics at all on the show.
Yeah, I mean, I think a number of the calls that I've had recently certainly been revolved around the election. And you're right, I will make a point if it's something to do directly to real estate. If it's a bigger picture, political thing, I won't. So I think, yeah, is there some people maybe holding on the sidelines a little bit? I think that's the case.
Okay.
I think also a lot of people are waiting for more inventory to come on the market.
Yeah.
Because there's more choice out there. You see, we're in a situation right now when we talk about lack of homes for sale. It's kind of a chicken and egg argument. And that is the fact that I want to move, that's great. If I find somewhere to buy, I will sell my house or list my house.
Yes.
If I can't find somewhere to buy, I'm not going to list.
Yes.
So which one gives first? I think we'll see somewhat greater inventory at levels. We're slowly seeing that already. The numbers that came out from the local multiple listing service a couple of days ago demonstrated that we're seeing some increases, which is good.
Okay.
Price growth is still higher than average. But I think we will see some more listings next year. But it will, I'm afraid, not be enough.
Yeah. Okay, so Mathew, let's switch over to interest rates. And at a close historical low, when are they going to change?
We see, I'm not the only economist in the country that analyzes real estate that has forecasted interest rates and got it completely wrong for the last 3 years.
I know. I say, after the last 3 years, as experts, we're all right 50% of the time.
That's true. Yeah. So the way you have to look at it is the fact that we all expected rates to go up when essentially the government turned off the printing presses, when we stopped qualitative easing, we stopped buying treasury bonds, 10-year bonds, and the yields on mortgages track treasuries, the yield on the 10-year paper.
Yes.
So as we stopped printing our own money to buy that debt, we assumed that the yields would have to rise.
Yes.
Because there'll be less demand. You've got to pay a greater interest rate. As that happens on bonds, the same happened on mortgages. Didn't happen.
Yes.
Didn't happen for several reasons. One of which is you've still got a pretty hefty appetite for our debt from overseas. From China, the second largest donor of US debt, to Japan, the third largest, and actually even down as far as Russia. With the collapse of the ruble, what you found is there's a lot of money coming in and flowing into the bond market. In additionally, there's people like you or I who say, well, we think the equity markets, the stock market, is getting a bit frothy.
Yes.
And they're pulling some money off the table, putting it into the safety of bonds. Right. So given all these things in concert with each other, that kept rates remarkably low. Now, I do promise you, mortgage rates are going to go up.
Yes.
They really will. And my forecast right now is we might get to 4.3% on the 30-year fix by the end of next year.
Yeah. And who would have thought, Mathew, that we hit another all-time low? I mean, literally, we had another historical low. So it's kind of like this is our new norm. But once it starts changing. And
it will. And ultimately, it has to. And so, yes, you're right. We hit that low twice, which is quite remarkable. No one was seeing it. But they are going to go up, but the point is they're going to go up very modestly, which also plays into the is there a housing bubble argument as well.
Yeah.
We're not going to see a big spike.
Okay.
We shouldn't see a big spike, but we'll talk more about after the election. Yeah. But we're unlikely to see that. And as long as that's the case, then borrowing costs are still going to be historically remarkably cheap for everyone other than millennials.
Okay.
You're going to find millennials coming into the market next year or so and saying, what do you mean I've got to pay 4.5% for a mortgage?
Yeah.
That's a rip-off.
Yeah, because all they know is these ridiculously low rates.
Yes. Exactly. Now go back to 1990 when they were 10%. Go back to 1980.
We got to get out our charts.
Exactly. Go back to 1982
Yes.
when mortgage rates were 20%.
Yeah,
People
geez.
still bought houses.
Crazy. So, Mathew, we talked a little bit about new construction, but there's an awful lot of apartment projects being built. And are we ever going to see more condo towers coming up?
That's another fascinating question. To start off with, we're seeing a huge amount compared to our historic averages of new construction on apartments. Why is the question I think a lot of people put out there. And basically speaking, you're finding a lot of developers that are building apartments and not condominiums. They're doing that for several reasons. One of which is you can actually borrow money to build apartments. It's still very, very difficult to get construction financing to build condominiums. Point two, you build a condominium tower, you will get sued.
Yeah.
It is inevitable.
So it's the risk.
It's the risk. And so to offset that risk, you've got to buy wrap insurance, which is remarkably expensive. Secondly, it's expense. It's the cost of building the condo towers.
Okay.
It's very, very expensive. So how deep is that market when you're having to pay $800-900 per foot to buy a condo?
Yeah.
There's a market out there for that, but how deep is it? Now, so that makes building a condo maybe not as hot as it used to be.
Okay.
On the other hand, you're building apartments. You can build apartments. That's great. Is there demand for them? What's happening right now is the institutional investment community from across the country, everyone's chasing yield. Everyone's chasing a return because they have pension checks to write out and these kinds of things. They are buying these projects as quickly as they are being built.
Okay.
So huge amount of demand from institutions. So a developer can borrow money. Banks are happy to lend on apartments. He will not get sued because he's going to sell it.
Yeah.
He'll get paid essentially as much money as he would do building a condominium, and he'll get paid about 2 years earlier. So you want to know why everyone's building apartments?
Yes, makes total sense. So then on the high-rise condos for purchase, that would make sense that appreciation, the ability for appreciation is... There's a lot of opportunity for those to appreciate at a high level if there's going to be supply and demand.
Yeah, well, we've certainly seen in a couple of projects which have been built, certainly, let's say in downtown Seattle, Insignia and Luma are the two ones which immediately come to mind. Great demand, selling remarkably well, if not almost sold out by now. So we certainly know there is an amount there. Now, do I expect to see a lot of new condo towers? No. Could we do with a few more? Yes, actually we could. But I just don't see that we're going to see a plethora of them coming on the market.
Because we're still seeing, people want to live in high-rise condos. They want that lifestyle, and there's only so many out there. So I want to go back to or talk about rents. The rental market has been as crazy as the housing market. Multiple offers on a rental home. So what are you seeing with the rental market, and how is that indicator of the housing market?
Okay. Well, the rental market, I would suggest it's bifurcated. When I say bifurcated, what I mean is the fact that we're seeing a huge amount of development activity and huge rents occurring where? Belltown, South Lake Union.
Yes.
That's essentially where it's happening, right parts of Capitol Hill, where we're seeing an awful, 6,000-7,000 units coming online over the next couple of years per year. So a huge amount of new supply. That's okay, but we're not seeing that development patterns occur out in the suburbs. Now, what I believe right now, I think we're in a bit of a speculative bubble when it comes to apartments. So we're seeing apartment rents escalate at very remarkably rapid rates. And so we're at a point now whereby, as far as I can see, the next probably year, 18 months, we're going to bring on so many apartment units, that's going to cause rents to drop.
Really?
Yeah, at least certainly in the urban markets of downtown Seattle.
So when that happens, that obviously has an effect on the housing market.
It does. And we're getting to a point now, and certainly on these high-rise apartments, we're looking at rents where people are having to pay $2,000, $3,000 per month in rent.
Yep. Yeah.
Now, you and all your listeners can figure out what that equates to in terms of the ability to borrow, to buy.
Yes.
Now, there were certainly post the recession, a lot of people saying, well, you know what, this is the renter generation. All these young millennials, they're never going to buy, they're going to rent forever. I totally disagree with that.
Okay.
They will buy. They're postponing it by about 2 or 3 years, but they are going to buy. They are actually going to start seeing the value of owning rather than renting.
Yes.
They're going to come into the marketplace, but the big question is, will there be anything for them to buy?
Yeah. On that, I'm going to take us to commercial. Coming up next in the Money Hour, more conversation with Mathew Gardner, Chief Economist with Windermere on real estate, right here on 1150 AM KKNW after this short break. Welcome back to the Money Hour with your host and mortgage expert Tina Mitchell right here on 1150 AM KKNW, the Saturday, October 8th show. I provide you the news on everything money, fresh information on market trends and conditions in our local economy. If you're hearing my show at a different time or day, you are listening to a rebroadcast. You can call into the show with any questions for my guest or future guests that you'd like to have on the show, 1-855-400-1150 or online at themoneyhour.com. Back with Mathew Gardner, Chief Economist with Windermere Real Estate, having a conversation about what's happening in the economy, our real estate interest rates. Mathew, again, thank you so much for taking time with me.
Always happy.
So any changes that you're seeing coming that are going to affect the local real estate market negatively and positively, other than what we've talked about already?
I would say that the one thing that keeps me awake at night right now relative to the local housing market here in Seattle is housing affordability.
Okay.
And there's a big reason for that. And it all breaks down to the competitive nature of our city to grow and expand and attract businesses to come in. Now, we're obviously right now very, very lucky with the amazing businesses, the Amazons, the Microsofts, etc., that we have here. And we're attracting more. I mean, LinkedIn's coming along, Facebook's coming along. There are a lot of these very large companies are moving into the area or expanding into it. Now, one of the biggest decisions that when a company decides to move somewhere is, how much do I have to pay my staff? And the biggest component of that is shelters, cost of living.
Yes.
And at some point, it is quite likely that they're going to look at Seattle in a similar way some of them do to, let's say, the Bay Area, and say, it's too expensive. I have to pay my staff too much money. So all of a sudden, our competitive edge can possibly start slowing down.
Got it.
And so a lot of these companies now are regional, national, or international. And at some point, we're not there yet, but it wouldn't surprise me to see CFOs saying, well, no, we could be in Seattle, but why not Coeur d'Alene, Idaho?
Oh, my gosh.
Exactly.
Wow.
Because of the fact of housing prices here.
Yes.
And also you have to add on to that congestion and traffic and various other issues that we have, which are very, very major issues.
Yes.
So housing affordability, I would say,
is my biggest one. And 2033 is quite a ways off.
It is. ST3, personally speaking, I think is a great proposition. But he said it's over a very, very long time horizon.
Yeah.
And so we certainly can't guarantee it will pass. But we want to fix housing affordability. We have to fix transit.
Yes.
And that by far is the biggest issue, I believe, that we have as a region.
Do you think that they're putting enough attention on housing affordability? Any new things that are coming out that they're initiatives that they're trying to put together for that?
Well, yes. I mean, it's the city of Seattle certainly has put together several committees and a perceived called Grand Bargain to try and figure out how do we create housing or make housing affordable.
Yes.
Personally speaking, and I've been on some of these committees, I think that looking at it purely on a city-by-city basis is remarkably naive. We have to understand that housing affordability is a regional issue that requires a regional response, not just the city of Seattle saying, we've got a problem in Seattle.
Yes.
There's a problem everywhere.
Yes.
And it's a very big one. It's a very tough one to address because the bottom line is housing affordability tends to be driven by land.
And we don't have any.
The more land you have, it's fine. Yeah. So we have these huge topographic constraints. We have mountains, we have water, and really kind of our region is remarkably linear.
Yeah.
And so we have that. Then layer onto that geopolitical aspects, which is growth management and urban growth boundaries, saying where you can build, where you can't. So that further limits supply.
Yes.
Now go back to Economics 101. Limit supply, have net new demand. What happens to prices?
Yes.
They go up.
Yes.
And that's certainly what we're seeing here. Now, we have land, don't get me wrong. But the trouble is, it's that if you ever tried driving, let's say, from Kent to downtown Seattle or from Everett to Seattle when it's raining, then you're looking at an hour to 2 hour commute. Now, if we can move people around in a way that they can be at their offices or within, let's say, 30 minutes, then I think that opens up large swaths of land, both the north as well as to the south.
Yes.
That because some become viable at land price, which is a lot lower, which means the house price will be lower, which therefore starts addressing.
Well, and and I've seen articles where they really have talked too about employers making more consideration of people working from the home. You know, I know it's not a big popular thing yet, but there's been conversation around it with technology and the ability to be able to do that.
There has, and that's something which actually came up probably about a decade ago. We started talking about working remotely, I believe.
Yes.
Now, some people tried it and they thought it was a great idea. And roll out of bed in your slippers and down to the office,
Sure.
and there you go. Didn't work. And the bigger reason why it didn't work is that we like the symbiosis. We like being around other people and being close to them, around the water cooler and talking, rather than doing it remotely. And you lose that.
Yes.
And so therefore the first experience of that didn't work out quite as well. Now, that's not to say some people can't work a day or day and a half at home in a week, but certainly no more than that. And in aggregate, the people that can do that is not going to heavily influence the amount of people on our freeways or using our transit systems.
Got it. So, Mathew, what about consumer confidence? What are you seeing there now?
Confidence is looking up. I mean, both in general, consumer confidence, consumer sentiment they're trending in the right direction. It's kind of noisy. It tend to flip up and down quite a lot, and that's generally speaking right now because of the election. But the trend is positive. The trend relative to housing is positive as well. Why? Because all of a sudden our household wealth has actually increased. Our equity in our homes has grown. If you look at it as a country, housing in the US is worth about $23 trillion, give or take. So that's where we stand right now. Now, it obviously went down dramatically through the housing bubble, has recovered remarkably well. At the same time, our mortgage levels, we haven't added onto our mortgage debt in probably 6 or 7 years. We've kept it the same because down payments have gone up.
Yep.
So all of a sudden, there's a terrible time in 2008 when we turned negative in terms of equity in our homes. Then we turn positive again. It's acting as a very big cushion, which is good. I expect to see more HELOC activity. There's no question about that's happening already.
Yes.
As people look to take out for cash out financing, we'll see more of that. But it basically means if we're comfortable with the fact we have beneath us an asset which is worth more than we paid for it, that makes us comfortable.
Yeah.
And what's important as a country is the fact when we feel comfortable, we start spending money. America is a nation of buyers.
Yes.
And so if you look at 70% of our growth, GDP growth, is just us buying stuff. And as we buy more stuff, our economy continues to expand and grow. Now, we're not buying as much as we did a decade ago.
Yes.
And so we are being a little bit cautious. Savings rates going up, that's a good thing.
Yes.
But at the same time, it does mean we are feeling actually relatively happy about it. Beyond the fact of the question of the bubble, and that's, I think, very few people are worried about it that own. Maybe those first-time buyers that want to buy are feeling the pinch more.
Well, and I think, too, that now that we've gone through this as from consumer standpoint, we've seen drastic drop in real estate. People lost a lot of money, but we've seen the recovery and see how the market, we've experienced this down and up and back where we're at. So I'm sure that has, helps with confidence in getting into real estate, knowing that the real estate market always drops and it always goes up. So as long as you're not selling in a bad market.
Dropping is a relative word. I mean, I don't think we're ever going to experience the drop that we saw in 2007, 2008.
Okay.
It's highly unlikely that will ever happen again, unless we start lending money to anyone and everyone, which is very, very unlikely given Dodd-Frank and various other things.
Sure.
So because of that, yes, do we see peaks and troughs? Yes, but they are very, very modest. And you tend to find that less in markets which are supply constrained. So you'll see it more in areas, let's say, like Houston, which have no constraints to growth. Phoenix, again, no constraints to growth. They'll keep on building as far as the eye can see. We can't do that here.
Yeah.
And yet the last time more people moved out of Seattle than moved in was 1973. So every year, a lot more people coming in than going out. That increases demand, and we still have a limited stock of housing to buy.
Yeah. So, Mathew, I want to switch this on a little bit different topic here and talk about the issues that we're having with appraisers. Because and another thing, actually, before we go, that I want to give a shout out with Windermere, because it's really unusual for a real estate company to hire a chief economist, specifically through the real estate company. And so let's go there first. I want to talk about that in Windermere and the decision for them bringing you on and really having that part of the team.
Well, I've been very fortunate. I was a consultant with Windermere and have been for almost 20 years. So back in the mid-1990s, that relationship started out. About 5 or 6 years ago, the president of Windermere and I were visiting about immediately post-housing bubble, what could have been done differently, how we could have looked at it differently. And that's when was mentioned, well, what if you actually kind of came to work for us?
Yeah.
It took a few years to figure out how that would look and what that would be. And so, I certainly give the family a huge amount of credit for saying that, for bringing somebody on like myself, because we are the only traditional brokerage in the U.S. that has its own economist.
Wow. And you're known at every real estate company. I mean, whether it's RE/MAX or John L. Scott or Colby Ricker Bain, everybody knows who you are, and you go and speak with them and really talk about what's happening with the market. So let me get back to being, I wanted to start with that too, because you're with realtors all the time and educating in what's happening and how to prepare for the market. The appraisers, the lack of the appraisers and what's happening. Do you see anything changing with that? And because it's a real challenge when it comes to timelines.
In the short term, I'd say no. Right now, appraisers obviously were kicked to the curb a lot after the end of the housing bubble, and they were blamed to a great degree for it. And certainly it's not entirely their fault, but they had to accept some kind of culpability. So because of that, they are being remarkably more cautious now, and they're taking their time, and they're dotting their I's and crossing their T's, which they probably should have done before. But it takes a lot longer now. So rather than doing 3 or 4 appraisals in a day, they're not doing it. So we have a lot more demand. Transactions velocity is still higher. We're not bringing on that many more appraisers to come in. So therefore, people are having to wait. And that is a problem. There is a backlog already. And I don't see that going away anytime soon. Now, in the longer term, I'll be honest with you, I think appraisers are somewhat remind me of dodos. And when I say that, it means that, do I think it's a business which will be around forever? I really don't.
I totally agree with you, Mathew.
I think it's essentially appraisals are going to become automated.
Yes. Yeah.
And so with that, if anyone's thinking about becoming an appraiser, think about it in a short to medium term, maybe not the long term.
Yes. Great advice. So, Mathew, let's talk about real estate professionals. I have a lot of real estate professionals that listen to the show. They come in and share their wealth of information as well. What advice are you giving the seasoned agents in this market right now to navigate and to really thrive?
Well, I'd say that certainly those that represent buyers, they're having a hard time. And they're having a hard time because they are being accused of not showing their clients something they want to buy. And the problem is there's nothing on the market to buy.
Exactly.
And so it doesn't matter if there's nothing on the market, it's still their fault.
Yes.
And so be patient, and they are very, very good at doing that because it is going to be arduous. And quite frankly, for the buyer themselves, they're getting tired. And they're going to start blaming somebody. And it's kind of kicking the dog, so to speak. So I think I'd say hang in there, it's going to be okay. Beyond that, I think that it's going to be important for the broker to be, one, obviously they're very knowledgeable about the market, but also to be able to demonstrate adequately the fact that, no, we're in a great region. House prices, yes, you may see some fluctuations, but the trend will continue to be upwards, which I certainly think it will be. And we can demonstrate that in the real numbers out there. So I'd say, and as far as people representing sellers, what is interesting right now is that sellers' perceptions are quite ridiculous. When I say ridiculous, as to what they believe they think they can sell their house for.
Yes, which is so unbelievable because there's numbers and there's stats and...
Right, but we've seen the average list price in King County for single-family homes be above $1 million for the last 9 months. Which is actually 10 months, which is quite astounding.
Yes.
And so it's up there because the belief is, well, there's all these buyers out there, there's very little supply, therefore I can put my house on the market for $100,000 more than it was 3 months ago. So I would say to the agents, just be cautious about that. Don't actually need the listing per se. Certainly it's important, it's your business, but don't just accept any number that gets thrown out there, because we are finding some listings hanging around. Buyers are sensible, as are their brokers, and they're not going to overpay.
Yes. So stick with what you know the property value is, and if the seller can't agree, then move on to the next one.
Absolutely.
You want to represent somebody that's going to be realistic in the market. A shout out to anybody that's thinking of getting into the industry, Mathew, and selling real estate. What would you say to them?
It's a lot of work.
Yes.
In the belief
not as easy as it looks.
The belief that it's very easy and very lucrative, and the fact perhaps you spent too much time watching reality TV. And some people
it does look glamorous.
And it does, doesn't it? Or somebody running around in $400,000 cars.
Exactly.
And spending millions on weddings. Anyway, but I'd say that, no, it is a lot of work. And it's not normal timing. Now, what is interesting, we are seeing some of this millennial generation, younger people coming into the business. And they're fascinating because they want to work, and they do work remarkably hard. They do actually have a very good life balance. So they'll come in and they'll work for 5 or 6 hours, just nose to the grindstone. Then they're saying, well, no, in the afternoons I want to go hiking. I want to do actually have a life. And so that's going to be interesting because that tends to be what we don't see from, let's say, the more seasoned veterans out there.
Yes.
So, but is it a good business? Yes, it is. It's good to see young people coming into it.
Yeah.
They're remarkably enthusiastic. But I would say if you're going to get into it, understand the fact that it is not a 9-to-5 job.
Yeah. And
nor do you get a 9-to-5 style paycheck. So it's you will be self-employed.
Yes.
And with all the consequences, good and bad, that entails.
Well, I'll give a shout out for seasoned agents or for new agents. Ninja. Windermere's got an amazing training program to keep you up to date on everything you should be doing. Less than 60 seconds, Mathew. Shout out final words for my listeners.
If you're thinking about buying, keep on looking.
Yes.
It is a tough market, but there are houses out there. Get in there now because mortgage rates, I said, they are going to go up. And that will have an influence on what you can afford, as you mentioned earlier on. So be patient. It's going to be tough, but you will find somewhere. And it is going to be a great asset to have in the long term.
Great advice. Mathew, thank you so much again for coming into studio. Always a pleasure.
You are always welcome.
Coming up next on the Money Hour, what is your story and how can you take your business to the next level? By sharing it. Sally Fox with Engaging Presence right here on 1150 AM KKNW after this short break.